Hello and welcome to SRIRAM's IAS. Today, you all might be knowing that we have started this series in which we will be discussing the prelims through PYQs. When we talk about the importance of PYQs, we all know that this section holds significance in terms of your number of marks which you will be getting in prelims. Why so? Because in today's discussion also we will be seeing this thing that how UPSC repeats the themes and the topics based on only one thing, that is the conceptual clarity of students in this subject. Further, we also need to know this thing that economy per se is a subject which is mathematical in nature. When we talk about the mathematics behind this subject, we need to understand that it's a subject of numbers and it's a subject of concepts. That is why the conceptual clarity is more important in this subject. So let's begin the discussion. I want all of you to have full attention through these some of the minutes of your life which can be life-changing for you in this subject. Let's begin the discussion. The topic today will be inflation. Inflation in itself is a multi-dimensional concept. The subject is multi-dimensional in its nature. Further, this concept of inflation is itself having linkages and interlinkages with all the other topics and concepts of economy. When we begin with these questions, you need to understand that why is it important? Why do you see every day in newspaper that there is something or the other thing, one news or the other news talking about this inflation, price rise or maintaining the prices throughout the growth of our economy? Why RBI is so much concerned about the growth and maintaining the prices or the market price stability? Why is RBI so much concerned about it? Why? Because this is what determines the growth of India through the short term and long term tenures while we skim through the growth cycle in the past or the future. In both the cases, inflation does play its role. Now, see, the question which UPSC asked in 2022 was that which one of the following is responsible for maintaining price stability by controlling inflation? Who is responsible for this price stability and who is this organization, which of the department or the commission is responsible for this price stability management? If you read a few news articles or you go through such headlines, you will come to know this thing that it is RBI, the RBI's governor, who talks about the price stability, who talks about stable inflation, who talks about monetary policy and the goals of monetary policy. Fine. So this thing or this question could have been solved just by skimming through the newspaper. Leave aside the deep analysis which we do at SRIRAM's IAS. That analysis can give you the boost. That analysis can help you understand the concepts deeply. The nits and grits of every news has to be understood, and that is why we come to help the students. Now, this question was simple and it could have been answered. The answer is D, that is the main thing is price stability. It is the function of RBI to do this. Now, what RBI does, or what are the this divisions of RBI which particularly deal with inflation? We have the monetary policy or the monetary policy committee, which basically deals with inflation targeting, and the other goals or objectives of monetary policy committee is particularly when we talk about inflation, we have a set target of 4% plus minus 2%. because that is where we can see that the growth and price stability going in tandem with each other. Further, this inflation is dealt by various divisions in RBI also. There is the Financial Markets Operation Department which deals with the day-to-day liquidity in our markets. Further, you also need to remember that there are some of the instruments where it is repo, reverse repo, open market operations or liquidity adjustment facility which you need to know and which you need to remember, because these are such concepts which help you in solving these questions. Next, the question which UPSC asked in 2022 was an interlinkage of inflation with the comparative part of economics, that is when we compare the purchasing power of two economies or the domestic economy and the foreign economy. In this concept, what we do is we compare our domestic economy with the basket of economies across the world. So how do we select this basket and why do we do this comparison? Basically, the reason behind this comparison is to understand that how much actually do we have to work on in strengthening our economy, in strengthening our trade competitiveness, and to remove one thing, that is the inflationary effect in currencies, whether that is in India or whether that is in other foreign countries. So what do we do is we select 5 major currencies which are, dollar, pound, euro, yen and Swiss franc. These 5 currencies and their weightage. Then what we do is we select these 5 currencies, we see how much do we trade in dollar, euro, pound, Swiss franc. Once we decide this, the number is extracted, and then only at the last what we do is we see that how much weightage can we give to these currencies, and after that analysis we define the numbers and we find one index. The index number, if the value of the index is more than 1, it means that the rupee is strengthening in comparison to dollar, and if it is less than 1, then rupee is weakening in comparison to dollar. One concept which you need to remember. Next, there is no such defined international standard to select this basket of currencies. Now, what do we do? Every organization, whether that is OECD or whether that is International Monetary Fund, they select their own currencies for their own comparison. One more thing which we need to remember, that what is NEER and REER? Why do we need to understand NEER and REER? Because UPSC has asked this question, these two concepts, and then what UPSC did was it interlinked this NEER and REER with domestic inflation. Now see, solving this question was very much easy, but only if you have conceptual clarity then. If not, it could be a tedious task for you. Now understand, with reference to Indian economy, consider the following statements. NEER indicates the appreciation of rupee, while as the REER indicates an improvement in trade competitiveness. Reading these plain statements or reading them without understanding may create chaos and confusion in exam center for you. But if you know that the concept behind NEER and REER, why is it important also? Because see, you can see that there are articles popping up every day on this concept, whether that is the rising domestic price or real exchange rate. You need to understand that how appreciation and depreciation in this works. What is NEER? NEER is basically an unadjusted. What do we mean by adjustment and unadjusted? It is adjusted against inflation. When you adjust it against inflation, then it becomes adjusted weighted average rate. If it is adjusted against inflation, it will become REER. How? Now understand, it is basically derived from the trade weightage given to the currencies, and then only we derive this TWCI, that is a trade weightage currency index. Once it is derived, then only we can see that how much is basically the inflationary effect in our domestic currency and in the foreign currency hampering the trade. Okay? Why is so? Because we need to understand the trade competitiveness, that whether we are capable enough to trade in better terms or not. Okay? Now, understanding this, how is it helpful in trade competitiveness? Understand, first we saw what is NEER and then what is REER. Once NEER is adjusted to compensate the inflation, it becomes REER. Second most thing, NEER is not determined for each currency, remember. It's not determined for each currency separately, but a bunch of currencies or a basket of currencies. Further, it is a relative value. It is not the exact value due to which we can derive that it is actually the strength of the currency. No, it's not. It is a relative value, that is, it is in comparison, not without comparison. Got it? Next, it does not define the strength of the currency. Remember it. It does not define the strength of the currency. Then what it does? What it does is actually it defines the trade competitiveness of currencies. How? See, if the appreciation of NEER happens, what do we mean by appreciation of NEER? That is, the domestic currency increases against the basket. That is, the power or the purchasing power of domestic currency is increasing in comparison to the basket of currencies which we have considered. That is appreciation of NEER. Second, REER. REER is again the weighted average of currency against the basket or the index which we read. Further, the weights in the NEER or the REER, the weights in the REER are assigned as per the trade balance. The amount of trade which we do with these currencies defines the weights which we use in REER. Last में, if there is an increase in REER, that is, if there is an increase in the index of REER, if the index derived from REER is increasing, then what happens is the trade competitiveness decreases. Why? It means that our exports are getting expensive and our imports are getting cheaper, which means that हमारे यहाँ से exports कम हो जाएंगे, our exports will decrease. जिसका ये मतलब होगा जब हमारे एक्सपोर्ट्स कम हो जाएंगे that we will be gaining less in terms of trade. ठीक है, our deficits will increase. That is what UPSC asked in its question. What it asked, that an increase in real effective exchange rate indicates an improvement in trade competitiveness, which was a wrong statement. Further, an increasing trend in domestic inflation relative to the inflation in other currencies is likely to cause an increasing divergence between NEER and REER. As we said, NEER is unadjusted, REER is adjusted, which means अगर inflation बढ़ रहा है domestic economies in comparison to foreign economies, it means that the two indexes will start diverging because inflation is rising. So the divergence is something which conceptually can be derived by a student if he applies the logical mind. ठीक है, चलो. With this, question number 2 we discussed. It was asked in 2022. Second and third statement are correct. B will be the answer. Moving further, we have one more question on inflation only. This question UPSC asked, very simple question, that if the inflation is too high, अगर inflation बहुत ज़्यादा है, then what will RBI do? Is likely to buy. Do you think that RBI will buy? What will it buy? It will buy government securities. What do you think of this statement? Or what do you think that how RBI operates through the mechanism of open market operations? What RBI does in these open market operations, you must be remembering, because this is something which is dealing with your basics, your foundation, which has to be clear. If not, you need to revise it because prelims is very near. You cannot skip revising the basics. Now second statement, it says that if the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. Again, see how UPSC is interlinking the concepts. One concept is related to the external market, that the external exchange management or the exchange rate. The first is about the money supply, the open market operations. And third statement is when we deal with the other countries or when we compare our domestic currency with the foreign currencies. It says if the interest rates in USA and European Union were to fall, that is likely to induce RBI to buy dollars. Now see how much interlinked is this concept of inflation and how UPSC puts in so much of efforts to create such questions. Very, very conceptually well enriched question, but do not fall into the trap of just eliminating that no, RBI will not buy, it will sell. Okay. That is just to avoid your understanding and building a civil servant inside you. You cannot do that. That is not justice for you. You need strong foundation, you need strong basics, then only you will be a successful civil servant. Now, understanding the concept, the question was per se very much easy. Anyone ABC can tell you that RBI does not need to buy the government securities, it will sell. Why? Because if it buys the government securities, what will happen? It will supply more money into the market, which will create more inflation in the market. So, it is simple. In order to control the high inflation, what RBI should do? It should sell the government securities, not buy the government securities. You getting me? That is very much logical. But just एक statement पढ़ के उसका एक word eliminate करके, you cannot just go through UPSC, है ना? UPSC puts too much of brains into it. ठीक है? It's exam center and you need to be clear with your basics. Now understanding the question a bit detailed. ठीक है? चलो. RBI, see ये question जो है ये conceptually interlinked था और ये हमारे UPSC ने, हमारे examiner ने इसको बहुत ज़्यादा deeply बनाया था, research करके बनाया था. RBI has 3 dimensions where it controls inflation. As we saw, RBI is actually responsible for controlling the inflation and maintaining the price stability, which we saw in the first slide and the first question itself. Now, what RBI does is, in the foreign market, what it does, it checks continuously what are the monetary policies of other countries. If there is an expansionary monetary policy in a nation or USA per se, you see Canada or European Union is doing an expansionary monetary policy, which will mean that currency over there, loans over there will be now cheaper, which means that the people, FIIs, foreign institutional investors, they will have more money now to invest it into other markets, which likely means that India will be getting more money into its markets, more investment into its markets. One thing. Second, RBI continuously checks the foreign economies and foreign institutional investors. Further, RBI also sees forex market. Forex market, RBI sees that how much supply of dollar is there in the market. Suppose USA or the Federal Reserve of USA adopts a tight monetary policy. What it does is, it stops the supply of dollar in the market. What will happen? There will be a shortage of dollar in the market. Once the shortage of dollar happens, so what RBI should do in order to maintain the exchange rate of rupee, what RBI should do, it should supply more dollars into the market so that rupee does not depreciate totally. To stop the depreciation of the rupee, what RBI will do is, it will supply more dollars into the market. Done? Third thing, what RBI does, it sees the instruments in debt market also. What it does, it sees the interest rates, it controls the interest rates, it controls the inflation, it checks the government securities through open market operations, it sells and buys the government securities in order to maintain and check the inflation, in order to maintain and check the money supply in the market. Done? So these are the three dimensions which you should be clear of once dealing with such questions. Next question, very much important question, because in order to understand this question you need to know that in 2013 these bonds were issued and they were recommended, and then in 2014 the recommendations were adopted and we issued these bonds. Now understanding this thing, we need to know that what are inflation indexed bonds. Okay? As I usually say that in order to understand the numerics in economy, you need to understand 100 rupee calculation. बस 100 रुपए का कैलकुलेशन अगर आपको समझ आता है तो आपको इकोनॉमी में न्यूमेरिक्स समझ आएंगे, बट वहीं पे अगर आपको इकोनॉमी की टर्म्स को समझना है और उसके पीछे का कॉन्सेप्ट समझना है, व्हाट यू नीड टू डू इज वन थिंग, break down the term. Once you break down the term easily, you can understand very lucidly that how to solve this question. Simple. The bond is inflation indexed bond. These are the three terms involved in this question. What is inflation indexed bond? It means a bond, an instrument which is indexed against inflation. Simple. There is an inflation index, suppose it's wholesale price index, which shows us that the inflation is on the rise or on the decline. Simple. What we will do, we will just read the index. What we will do is we will interlink the numbers of this index with what? With the bond or the instrument which we have floated in the market. What will happen by interlinking these two? It means that once the inflation is on rise, the compensation which is given to this bond or this instrument will also rise. If the inflation is on decline, it means that the bond will have, or the holder of the bond will get the interest and the principal amount with the effect of the inflation. Usually what we see is long-term inflation is on rise because we need to grow, and growth and inflation are always parallel to each other. They grow with each other. Now what we do is we link these two things. One is the inflation and the bond which is in the market. Why do we do this? In order to attract more investment into bonds and to make sure that the investors or the lenders of these bonds, the people who are buying these bonds, they ensure to themselves, they understand that yes, the market is positive, we can invest. Why? Because inflation के जितनी जो ग्रोथ है उस ग्रोथ को कंपनी या गवर्नमेंट पहले ही कैलकुलेट करके चल रही है. Understood? Then only they have this faith and belief in these bonds and they start investing more, which makes the investment more attractive. Now understand, we broke down this term that inflation indexed bond. Now let's understand the three statements. Just हमने break down किया है. Government can reduce the coupon rates on its borrowings by way of inflation index bonds. कि क्या गवर्नमेंट अपने कूपन रेट्स और यू कैन से इंटरेस्ट को डिक्रीज कर सकती है, और जो उसको कॉस्ट ऑफ बोरोइंग है, क्या उस कॉस्ट ऑफ बोरोइंग को वो डिक्रीज कर सकती है? कैसे? इन्फ्लेशन इंडेक्स्ड बॉन्ड से. दिस वाज द सोल पर्पस ऑफ दीज बॉन्ड्स. नेक्स्ट, inflation indexed bonds, they provide protection to the investors from uncertainty regarding inflation. What they do is they provide protection to the investors from uncertainty regarding inflation. This is what the bond की जो ये term है inflation index bonds, that is what the term says. Simple बोल रही है ना, inflation को index करना है bond के साथ. बहुत simple term है और बहुत simple term का ये बहुत simple meaning है यहाँ पे. Third, the interest received as well as capital gains on IIBs are not taxable. Now, by the term, do you understand anything which is regarding the tax or capital gains? Do you see anything or coming out of this term that there is something which is capital gains on IIBs or the taxation on this term? If there would have been taxation also, first understand that this bond, in this bond, what we are doing is, हम जो ये बॉन्ड खरीद रहा है उसको सबसे पहले सिक्योर कर रहे हैं इन्फ्लेशन के अगेंस्ट में, उसके बाद उसका यील्ड भी इंश्योर होगा क्योंकि ये बॉन्ड अच्छा है तो उसको यील्ड भी अच्छा मिलेगा. दैट इज समथिंग विच कैन बी अज्यूम्ड. ठीक है. फर्दर इन्फ्लेशन का पैसा भी वहां पे उसको बच रहा है, दैट हिज इफेक्ट गेट्स नलिफाइड विद once he compare or calculate the inflationary effects. Then also you need to understand this thing that now exempting the capital gains is something which will be, I guess, injustice to the economy. Therefore this statement was wrong, and the first two statements are correct, because the whole purpose of introducing these inflationary index bonds was to ensure that the coupon rates of government get decreased. Now let's just understand, because I always focus on understanding that how these coupon rates will get decreased on the cost of borrowing, or how the cost of borrowing of the government will decrease in the long run, or how government can ensure that its coupon rates are decreased. Let's just understand that concept very easily, very lucidly. Simple. I'll just make you a simple understanding that if, for say, we know that it is Government of India, it is RBI which is maintaining the inflation in India. And we know that RBI, not we, but the government knows that we can control inflation in long run. At this point of time, what we need is, we need more money or more investment into the market, so that once the investment increases, the market will grow. Once the growth is there in place, we can control inflation by our prompt corrective actions. One thing, what banks or what government will do is, it will ensure this thing that if there is an effect of 4% of inflation in current times, and in the future, after 2 years or after 1 year of maturity of these bonds, what we will do is, at that point of time, we would have controlled the inflation at 2%. Further, what we are going is, we are giving a 1.5% of the indexation on, or the interest on these bonds. Therefore, the cost of borrowing or the cost on these bonds will be just 3.5%, which otherwise would have been more than 4%. Therefore, a simple illustration, as I said, always I do say this thing that what you need to do is, you need to just assume 100 rupees calculation. How you do this? That the wholesale price index inflation at current times was 4%, and the IIB's interest rate was set at 4% plus 1.5%, and then in the future, how we can define that government's coupon rate has decreased to 3.5% is by decreasing the inflation to 2%. That is how the government can ensure the control of inflation in future, or ensure that its cost of borrowings has decreased. Okay? That is about the inflation index bonds. Okay? Further, how do we do this inflation indexation? RBI has to, in the first slide also we saw this thing that RBI has to maintain, and RBI has launched these inflation indexed bonds in order to ensure that these bonds work well. They were indexed at the wholesale price index. The interest and the principal amount of the bonds was ensured and indexed against wholesale price indexation or wholesale price index inflation, which means that there was a fixed coupon rate on the principal which was adjusted against the inflation. Okay? Now, the indexed bonds, understand, the indexed bonds, what they do, any indexed bond, what it does is, first, it checks the real rate of return, and second, it gives a compensation. First is the real rate of return, that is the interest rate on that bond, which is given. Second is that, why is it called the real rate of return? Because it is adjusted against inflation, the inflationary effects are removed, and then we check that how much real rate of return has been achieved on these bonds. Second, the compensation. The compensation on purchasing power erosion. We all know, why am I defining it here? Because we will see that in the upcoming questions, purchasing power against the inflation. This concept, that inflation actually degrades or it decreases the purchasing power. Now understand this thing, that compensation or purchasing power erosion basically happens through what? This purchasing power erosion happens actually because of the consequence of what? Inflation. How does the indexed bond check this purchasing power erosion? Is by checking that the effect of inflation on the returns of this bond has been nullified. ठीक है, done. चलो next. Last में we have this question which talks about demand pull inflation, and demand pull inflation can be caused or increased by which of the following? First is expansionary policies. This will supply more money into the market. Fiscal stimulus and inflation indexation of wages. What do you think? अभी हमने जो कॉन्सेप्ट पढ़ा था इन्फ्लेशन इंडेक्स्ड बॉन्ड्स का, उससे क्या हुआ? उससे डिमांड पुल इन्फ्लेशन बढ़ेगी या नहीं बढ़ेगी? उससे डिमांड पुल इन्फ्लेशन नहीं होगी, उसके इन्फ्लेशन के इफेक्ट को कम करने के लिए वो लाया गया है. Therefore 3 was not the answer. Higher purchasing power. Again, if a person or an economy has higher purchasing power, which means that what? Is it the option to increase the inflation or to decrease the inflation? This will increase the inflation. That means that the currency is having more power to purchase more things. The purchasing power of the currency is high. Inflation actually decreases the purchasing power of the currency. ठीक है? Now understanding the question, rising interest rates. इंटरेस्ट रेट जितना ज्यादा होगा उतना कॉस्ट ऑफ बोरोइंग ज्यादा होगा, जितना कॉस्ट ऑफ बोरोइंग ज्यादा होगा उतना मनी सप्लाई कम होगा, लोग हेजिटेट करेंगे लोन लेने में. ठीक है, देयरफॉर द आंसर वुड बी 1, 2 एंड 4. ठीक है, नेक्स्ट क्वेश्चन. सी अगेन, जनवरी इन्फ्लेशन 5 months low 4.3%, or the inflation spikes 33 months high, which makes the imports and rupee depreciates continuously. Further, yes, market equilibrium का जो concept है ये आपको समझना होगा. Then only we can understand that how the demand pull and cost push inflation actually happens. ठीक है? Basically, the market equilibrium says that in market there is an equilibrium which is maintained by an efficient supply and an adequate demand in the market. If the supply increases, it means that there will be excess supply and the prices will increase. There will be excess supply in the market. While as if we decrease prices to the lowest levels, there will be the demand will be in excess and the products will go to waste. There will be excess demand and there will be scarcity of the products. Done. In Indian government bond yields are influenced by which of the following? Again, bond yield. ठीक है? What is bond and what is bond yield? Bond yield, we will discuss it. Just bear with me. The actions of United States, Federal Reserve, Reserve Bank of India, and inflation and short-term interest rates, which of these will hamper the bond yield? It all comes from the demand and supply. ठीक है? If the demand of the bonds increases, it means that, see, again, this was recently in news that the bond yields, they are to see muted start ahead of debt supply. So you need to be aware of these concepts and these news. Then only you can have a basic confidence of having an upper edge in the exam. Now understanding bond and bond yield is basically influenced by the monetary policy of RBI or the monetary policy of other foreign economies also. How? We will see that if the monetary policy is cheap and there is too much of money which is flowing into the market, it means that the interest rates have been decreased and now everyone is looking for investments because they are getting cheaper money. So what they will do is they will pursue the investment into bonds and other fields. Further, if the monetary policy, as we said in the foreign economies, is cheaper or expansionary, then there will be relative effects on the bond market and the securities market also. Interest rates, if they are increased or decreased, they will have effect on bond yield. Fiscal position of the government and borrowings by the government, this will also have an impact on bond yield. Why? Because if the government increases its borrowings continuously, if the government is increasing its borrowings, it means that government is just sucking out the money from the market. If the government borrowings are more, it may create the effect of crowding out in the market. Further, the global market and the inflation, whether in domestic or the global market, will also impact the bond yield. Therefore, D will be the answer of this question. That is, all the three will be applicable, or all the three will have impact or will influence the bond yields in Indian markets. ठीक है? चलो. Next, which one of the following is likely to be most inflationary in its effects? Again, the question was in 2021 and the answer is very simple. If you create more and more money to finance the budget deficit, it will have an inflationary effect in the market, because you are creating money not for the growth but to fulfill the deficit which already has been incurred in the previous years. What it means is that you are basically printing money twice for the same expenditure. It means that this will be more, and most of the inflationary effect will be by this option. Next, consider the following statements. The weight of food in consumer price index is higher than in the wholesale price index. Wholesale price index does not capture changes in the price of services, which CPI does. The Reserve Bank of India has now adopted wholesale price index as its key measure of inflation and to decide on the changing key policy rates. Basically, it was a decision which was recently taken by RBI, and this decision involved using CPI, not WPI by RBI. That is what made, or that is what inspired this question. Okay? Therefore, 3 will not be the correct statement. The answer will be 1 and 2. Okay? Understanding wholesale price index, the price before retail. Understand it. It is the price before retail, that is, before it is sold at the retail level, it is that price. It involves manufacturer, it involves the market supply, or whether it is the producer, then wholesaler, then the intermediaries also, distributors. Every cost is incurred in the wholesale price but before the retail price. Understood? It also checks the changes in the producer price, that how much, understand it, how much change in the cost has been incurred at the producer level or at the retail level. This thing helps us in understanding that whether there is a demand pull or whether there is a push in the cost of production in the economy. That is how we can utilize this wholesale price index. The main components of this are primary articles, fuel and power, manufactured products, and there is one more thing, that is food index also. This wholesale price index is basically published by the Office of the Economic Advisor under Ministry of Commerce and Industry. Further, this demand and supply in the manufacturing, construction and industry is maintained or showed, or you can say calculated through WPI. Further, the weightage of food is more in CPI than in WPI. In CPI, it hovers around 50%. Further, CPI, we have 200 commodities in the basket of CPI. The retail price is checked for goods and services both in CPI, not in WPI. There is only goods. The price change at the consumer level is also checked in CPI, because at the retail price or the retail level it is checked in WPI. Further, it is calculated by NSO, which is under the Ministry of Statistics and Program Implementation. Dearness allowances are calculated based on the CPI. The Rangarajan committee had recommended this thing, that the CPI should be calculated for rural, urban and food price also. Done? Chalo. Next question are the Urjit Patel committee recommendations, which I lately mentioned also, that basically these Urjit Patel committee, which was basically I guess constituted in 2015, and it gave its recommendations corresponding to that. It said that monetary policy should be based on consumer price index. Further, why it did so. Why did it recommend that? Because it said that consumer price index is that price which actually is impacting people and economy and which we should be dealing with, as the consumer price index is an internationally, you can say, comparative index and comparative number which we can use for comparing the Indian economy with the rest of the world. Done? Chalo. Last mein, we have one more question. It says that with reference to inflation in India, which of the following statements is correct? Controlling the inflation in India is the responsibility of Government of India only. No, we have been discussing this statement all along. I guess you should be capable of enough to understand this statement, that whether it is government only or there is the role of RBI also. Reserve Bank of India has no role in controlling the inflation. You know it. Increased money circulation helps in controlling the inflation. Already discussed. The answer would be C, that is the decreased money supply will be helpful in controlling inflation. Inflation benefits the debtors or inflation benefits the bondholders. First of all, you need to understand the debtors and the bondholders. Debtors are those who owe the money to someone. That is a person who actually has borrowed the money and now he is owing the money to someone. For example, there is a person A who gave money to the person or person B. Now B owes money to A. What does this mean? What does this transaction mean? It means that a person A had, for example, 100 rupees in his pocket. But at this point of time, the purchasing power of this 100 rupees was more than the present times. Why? Because at present time, the effect of inflation is to be calculated. The purchasing power of this 100 rupees has decreased, which will change the equation now. Okay. Therefore, this person B is a borrower. The borrower or the person B who actually borrowed 100 rupees, which had great value or great purchasing power, is now paying back this 100 rupee. The value or the purchasing power of this 100 rupee has decreased. Therefore, in actual sense, at this point of time, he borrowed money which had more purchasing power, or at this point of time when he borrowed the money, the interest rates were high. Now, when he is paying the money, the interest rates are less because there is too much money in the market. Okay? Therefore, inflation, leave that aside, the creditors or the lenders or the bond holders, how will they have effect in this market? The bond holders per se, or the person who lends this A, how will he benefit from this? Because he, first of all, he is lending 1000 rupees or 100 rupees to someone. He is lending 1000 rupees or 100 rupees to B. What he will do is, जब ये lend कर रहा है, ठीक है, first of all, ये जब ये lend कर रहा है, उस टाइम पे 1000 रुपीज का परचेसिंग वैल्यू ज्यादा था, उसने lend कर दिया ज्यादा इंटरेस्ट रेट पे, उस टाइम पे 2000 रुपीज प्लस इंटरेस्ट. Now, when he is lending, when inflation is in impact, understand this thing, he is lending 2000 rupees प्लस जो यहाँ पे ये 1000 रुपीज खरीद सकता था वो अब 2000 रुपये खरीद सकते हैं, ठीक है, एंड प्लस 2000 रुपये का इंटरेस्ट plus the long term investment which he is making, that makes the equation change. Therefore, inflation has different effects on lenders and borrowers both. Okay? Further, this concept basically comes from the quantitative theory of money. What does quantitative theory of money mean? There are 4 components of quantitative theory of money. It says that the money supply and the velocity of money, that is how much money is there and its velocity, is dependent or is equal to 2 things. One is the price rise in the market. Second is the real output of the economic system, that is the real growth in the market, excluding the inflationary effect. Therefore, the price rise can be calculated with this quantitative theory of money, which says that the price rise would be equal to the money supply and its velocity divided by the real output of the economy. I guess you have very well understood all of the questions, and With this, I conclude today's session. I wish you best of luck to all of you, and I wish that you join the series and continuously give your feedback and join in live for more interactive sessions so that all of your doubts can be solved in the live sessions only. Thank you. Jai Hind.